Hello, my dear students. A very warm welcome to all of you in Shri Jaindra Rank Zone. I am your friend and mentor for the subject Principles and Practices of Accounting. In this lecture, we'll start with Accounting Chapter 10, Unit 1, that is Company Accounts. Introduction to Company Accounts. Let us begin. Learning outcomes. After studying this unit, you will be able to understand the reason for the existence and survival of a company. Existence of a company and survival of a company. You'll learn the nature and types of companies, explain the salient features of the company, understand the purpose of preparing the financial statements of the company. Understood? Unit overview. Types of companies. We have private company, public company, OPC, one person company, small company, listed company, unlimited company, company limited by shares, company limited by guarantee, holding company, subsidiary company, and government company. Preparation of financial statements. These are statement of profit and loss account, that is profit and loss account, cash flow statement, balance sheet, and notes to accounts. Introduction to company accounts. Introduction. The never ending human desire to grow and grow further has given rise to the expansion of business activities, which in turn has necessitated the need to increase the scale of operations so as to provide goods and services to the ever increasing needs of the growing populations of consumer. Large amount of money, modern technology, large human contribution is required for it, which is not possible to arrange under partnership or proprietorship. To overcome this difficulty, the concept of company or corporation came into existence. While the invention of steam power ignited the human imagination to build big machines for the mass production of goods, the need to separate the management from ownership gave birth to the form of organization which is known as company or joint stock company. Company form of organization is one of the indigenous creations of human mind which has enabled the business to carry its wealth creation activities through optimum utilization of resources. In course of time, company has become an important institutional form of business enterprise which has carved out a key place for itself in the field of business operations as well as the wealth generating functions of society. What is the meaning of company? The word company in everyday usage implies an assemblage of persons for social purpose, companionship, or fellowship. As a form of organization, the word company implies a group of people who voluntarily agree in the form of company. The word company is derived from the Latin word com, that is, with or together, and pennies, that is, bread. Originally, the word referred to an association of person or merchantmen discussing matters and taking food together. However, in law, company is termed as the company which is formed or incorporated under the Companies Act 2013. Incorporated means formed under the Companies Act 2013. An existing company formed and registered under any of the previous companies law, that is the Indian Companies Act 1956, As per the definition of the law, there must be the group of persons who agree to form a company under law, and once so formed, it becomes a separate legal entity separate from the owners. This simply means what? That business, that is the company, is not equal to its owners, that is businessmen. The ownership is different and the management is different. I believe you understood. Having perpetual succession with a distinct name from its owner, that simply means what? That Mr. Mukesh Ambani is the CMD of Reliance Industries Limited. So the basically he is Mr. Mukesh Ambani and business name is RIL, a distinct name of its own and common seal. Its existence is not affected by the change of members. Members over here means shareholders. Shareholders. I believe you understood. Companies begs its origin in law. It is organization consisting of individuals called shareholders by virtue of holding of share of a company who are authorized by law to elect a broad or board of directors and through it to act as a separate legal entity as regards its activities. Generally, the capital of the company consists of transferable shares and members have limited liabilities. To get to the heart of nature of the company, let us examine the concept of company propounded under the corporate jurisprudence. According to Justice Marshall, a corporation is an official being, invisible, intangible, and existing only in the contemplation of law. That is, only by law. In the same manner, Lord Justice Hannay has defined a company as an artificial person created by law with a perpetual succession and common seal. A common thread running through the various definitions of company is that it is an association of persons created by law as a separate body for a special purpose. At the same time, definitions have laid down certain characteristics of a corporate organization which make it out as a separate and unique organization which enables the people to the capital of the company by subscribing to its shares and appointing elected representatives to carry out the business. I believe you understood. I believe you understood till here. Let us continue. Salient features of a company. Following are the salient features of the company. First, incorporated association. A company comes into existence through the operation of law. Therefore, incorporation of company under the Companies Act is must. Without such registration, no matter can come into existence. Being created by law, we can say that it is regarded as an artificial legal person because the company is registered as per the Indian Companies Act 2013. Separate legal entity. That simply means the company is having a separate legal existence different from the owners. A company has a separate legal entity and is not affected by changes in its membership. Therefore, being a separate business entity, a company can contract, can sue and be sued in its incorporated name and capacity. Supposingly, if somebody did not like the product of Reliance Industries Limited Say if somebody is not happy with the services of Jio Telecom, in that case, the person who is not happy with the services of Jio Telecom will file a suit against Jio Telecom and will not file a suit against Mr. Mukesh Ambani. I believe it is clear. Next is perpetual existence. Since company has existence independent of its members, it continues to be in existence despite of death, insolvency, or changes of members. Common seal. Company is not a natural person, therefore, it cannot sign the documents in the manner as a natural person would do. In order to enable the company to sign its document, it is provided with a legal tool called common seal. The common seal is affixed on all the documents by the person authorized to do so, who in turn puts his signature on behalf of the company. Companies Act 2013 required common seal to be affixed on certain documents such as bills of exchange of the company issued by the company, share certificates issued by the company. I believe you know the meaning of bills of exchange and share certificate. Now, the use of common seal has been made optional. All such documents which require affixing the common seal may now instead be signed by two directors or one director and a company secretary of the company. Next is limited liability. The liability of every shareholder of the company is limited to the amount he has agreed to pay to the company on the shares allotted to him. In fact, shares are fully paid up. He is just subject to no further liability, no additional liability. I'll make you understand this. See, supposingly somebody has bought 1000 shares of 100 each and he had paid 1 lakh rupee to the firm, to the company. In that case, if there would be any new liability on the company, the company needs to pay some creditor and there would be some additional liability. In that case, the existing shareholder will not contribute any extra sum of money because they had already paid 1 lakh rupee to the company. I believe you understood. Next point, distinction between ownership and management. In a company form of business, the one who are owners is different from the management since the number of shareholders is very large and may be distributed at different geographical locations. It becomes difficult for them to carry on the operational management of the company on day-to-day basis. This gives rise to the need of separation of management and ownership. Next, not a citizen. A company is not a citizen in the same sense as a natural person. Natural persons are citizens of the country is through it is created by the process of law. It has a legal existence but does not enjoy a citizenship rights and duties as are enjoyed by the natural citizens. I believe you understood. Next is transferability of shares. The capital is contributed by shareholders through the subscription of shares. Such shares are transferable by its members except in case of private limited company, which may have certain restrictions such as transferability. On such transferability, I believe you understood. Maintenance of books of accounts. A limited company is required by law to keep a prescribed set of books of accounts, account books, and failure in this regard attract penalties by the Indian Companies Act 2013. Next, periodic audit. A company has to get its account periodically audited through the chartered accountants appointed for the purpose of the shareholders on the recommendation of board of directors. Next, right of access to information. The right of the shareholders of the company to inspect its books of account with the expectation of books open for inspection under the statute is governed by the Articles of Association. The shareholders have a right to seek information from the directors by participating in meetings of the company through the periodic reports. Types of companies. Types of companies. First type is government company. According to section 2 subsection 45 of the Indian Companies Act 2013, government company means any company in which not less than 51% of the paid up share capital is held by central government or by any state government or governments, or partly by the central government or partly by one or more state governments, and includes a company which is a subsidiary company of such government company. Foreign company. According to section 2 subsection 42 of the Companies Act 2013, foreign company means any company or body corporate incorporated outside India which has a place of business in India, whether by itself or through an agent physically or through electronic mode. Next, conducts any business activity in India in any other manner. So this is foreign company. Next is private company. Section 2 subsection 68 of the Indian Companies Act 2013 defines a private company. A private company as a company which by its articles restrict the right to transfer the shares, except in case of one person company limits the number of its member to 200, provided that where two or more persons hold one or more share in a company jointly, they shall, for the purpose of this subclause, be treated as a single member. Provided further that persons who are in employment of the company and persons who, having been formerly in the employment of the company, were members of the company while in that employment and have continued to be members after the employment ceased, shall not be included in the number of members. Prohibits any invitation to the public to subscribe for any securities of the company. Shares of a private company are not listed on a stock exchange. Neither they can invite the public to subscribe for their securities of the company. I believe you understood. Next is public company. Public company. Section 2 subsection 71 of the Companies Act 2013 defines public company as a company which is not a private company. Public company is a company which is not a private company, provided that a company which is a subsidiary of the company, not being a private company, shall be deemed to be a public company for the purpose of this act, even where such subsidiary company continues to be a private company on its articles. A company which is listed public company, if it gets unlisted, continues to be a public company. No minimum paid up share capital. The minimum paid up No minimum paid up share capital. The minimum paid up share capital requirement is rupee 1 lakh in case of a private company, rupee 5 lakh in case of a public company, and has been done away with under Companies Act 2013. Accordingly, no minimum paid up share capital requirement will now apply for incorporating private as well as public limited companies in India. Next is OPC, one person company. Section 2, subsection 62 of the Companies Act 2013 defines one person company as a company which has only one person as a member. Next is small company. Section 2, subsection 85 of the Companies Act 2013 defines small company means a company other than a public company, which the paid up share capital of which does not exceed 50 lakhs rupees, 50 lakh rupees or such higher amount as may be prescribed, which shall not be more than 5 crore rupees. Next, the turnover of which as per the last profit and loss account does not exceed 2 crore rupees. Turnover should not exceed 2 crore rupees or such higher amount as may be prescribed, which shall not be more than 20 crore rupees. Note, the status of the company as a small company may change from year to year. Next is listed company. As per section 2 subsection 52 of the Companies Act 2013, listed company means a company which has any of its securities listed on the recognized stock exchange, National Stock Exchange, Bombay Stock Exchange, other recognized stock exchange. The company whose shares are not listed on any recognized stock exchange is called unlisted company. An unlisted company can be a public company or a private company. Unlimited company. Section 2 subsection 92 of the Companies Act 2013 defines unlimited company means a company not having any limit on the liability of the members. Company limited by shares. As per section 222 of the Companies Act 2013, company limited by shares means a company having the liability of its members limited by the memorandum to the amount, if any, unpaid on the shares respectively held by them. The next is company limited by guarantee. As per section 221 of the Companies Act 2013, company limited by guarantee means a company having the liability of its members limited by the memorandum to such amount as the members may respectively undertake to contribute to the assets of the company in the event of being wound up. Holding company. What is a holding company? According to section 246 of the Companies Act 2013, holding company in relation to one or more other companies means a company of which such companies are subsidiary companies. Next is, what is a subsidiary company? Section 2 subsection 87 of the Companies Act 2013 defines subsidiary company as a company in which the holding company controls the composition of board of directors, Next, exercises or controls more than one half of the total share capital either at its own or together with one or more of the subsidiary companies. A company shall be deemed to be the subsidiary company to the holding company even if there is indirect control through the subsidiary companies. The control over the composition of subsidiary companies, the board of director means exercise of some power to appoint or remove all of the majority of directors to the subsidiary company. I believe you understood. I believe you understood till here. Next topic, maintenance of books of accounts. As per section 128 of the Companies Act 2013, every company shall prepare and keep at its registered office books of accounts and other relevant books and papers of financial statement for every financial year which give a true and fair view of the statement of affairs of the company, including that of its branch office or offices if any, and explain the transactions effected both at the registered office and its branches, and such books shall be kept on accrual basis and according to the double entry system of accounting. Provided further that the company may keep such books of accounts or other relevant papers in electronic mode in such a manner as may be prescribed. Let us move ahead. Next topic, preparation of financial statements. Preparation of financial statement of companies. Under section 129 of the Companies Act 2013, the financial statement shall give a true and fair view of the state of affairs of the company or companies, comply with the notified accounting standard, and shall be in the form or forms as may be provided for different class or classes of companies as prescribed in Schedule 3. The board of directors of the company shall lay financial statements at every annual general meeting of a company. Financial statements as per section 2 subsection 40 of the Companies Act 2013 inter alia includes: first, a balance sheet at the end of the financial year, which is also known as statement of financial position. Statement of financial position. This is also known as position statement. Next, a profit and loss account, or in the case of a company carrying on any activity not for profit, an income and expenditure account for the financial year. For not for profit organizations, they prepare income and expenditure account, that is a replica of profit and loss account. Next, cash flow statement of the financial year as per accounting standard 3, cash flow statements. Next, a statement of changes in equity if applicable. Any explanatory not annexed to or forming part of any document referred to in subclause 1 or subclause 4, provided that the financial statement with respect to one person company, small company, any dormant company may not include the cash flow statement. Requisites of financial statements. It shall give true and fair view of the statement of affairs of the company as at the end of the financial year. Provisions applicable. Specific act is applicable. For instance, any insurance company, any banking company, any company engaged in generation or supply of electricity, any other class of company for which a form of balance sheet or profit and loss account has been prescribed under the act governing such class of company. In case of all other companies, balance sheet as per form set out in Part 1 Schedule 3 and Statement of Profits and Loss as per Part 2 Schedule 3. Compliance with accounting standards. As per Section 129 of the Companies Act, it is mandatory to comply with accounting standards notified by the central government from time to time. Schedule 3 of the Companies Act 2013. As per Section 129 of the Companies Act 2013, financial statements shall give true and fair view of the statement of affairs of the company or companies and comply with the accounting standards notified under Section 133 and shall be in the form as may be provided in different class or classes of companies in Schedule 3 under the Act. Let us move ahead. Part 1. Form of balance sheet. Form of balance sheet. Name of the company, say Reliance Industries Limited. Balance sheet as at 31st March 2021. Particulars. Figures as at the end of the current reporting period. Figures as at the previous reporting period. So over here it would be 2020-2021. Over here it would be 2019-2020. I believe you understand. Let us move ahead. Equities and liability. Shareholders fund. It includes share capital, reserve and surplus, money received against share warrants, share application money pending allotment, non-current liabilities. It includes long-term borrowings, deferred tax liabilities, other long-term liabilities, long-term provisions. Current liabilities, it includes short-term borrowings, trade payables, other current liabilities, short-term provisions. Total assets. Total assets. First, we'll write non-current assets. The list is exclusive. The list is inclusive. So, property, plant and equipment. How will calculate property, plant and equipment? Tangible assets, intangible assets, capital WIP, capital work in progress, and intangible assets under development. Intangible assets under development, trademark, copyright under development. Non-current investments, deferred tax assets, long-term loans and advances, other non-current assets. Next is current assets, current investments, inventories, trade receivables, cash and cash equivalent, short-term loans and advances, other current assets. Then total. Share capital. For each class of share capital, following points to be kept in mind: the number and amount of share authorized, the number of shares which are issued, subscribed, and fully paid up, and which are issued, subscribed, but not fully paid. The par value per share, share outstanding at the beginning and at the end of the reporting period should be reconciled. Calls unpaid and share forfeited. The next is reserves and surplus. Reserves and surplus can distribute among the following subheads. First is capital reserve. Second is capital redemption reserve, securities premium, DRR, debenture redemption reserve, revaluation reserve, surplus, the balance as per profit and loss account, profit and loss statement, and other reserves specify the nature of reserve. Next is long-term borrowings. Long-term borrowings can be classified under the following subheads: bonds, debentures, term loans, deferred payment liabilities, deposits, long-term maturities of finance, lease obligations, loans and advances from related parties, other loans and advances specify its nature. Long-term provisions. The next is long-term provisions. This can be classified as follows: employee benefits provision like gratuity, provident fund, etc. Next is other provisions. Specify the nature of the provisions. Short-term borrowings. Short-term borrowings can be classified among the following subheads: loans repayable on demand, loans and advances from related parties, deposits, other loans and advances specify the nature. Next, other current liabilities. Some of the other current liabilities can be grouped as under: first, interest accrued but not due on borrowings, income received in advance, unpaid dividends, application money received for allotment of security and due for refund and interest accrued thereon. Other current liabilities specify its nature. Next is tangible assets. Tangible assets can be classified as follows: land, building, plant and equipment, furniture and fixtures, vehicle, office equipments, others. A detailed report showing additions, disposals, acquisition through business combinations, and other adjustments and amount related to depreciation, impairment losses, revaluation should be provided for each class of asset. Intangible assets. Intangible assets are classified as follows: goodwill, brand or trademark, computer software, mining rights. publishing titles, copyright, patent and other intellectual property rights, services and operating rights, license and franchise, receipts, models, designs, formulae and prototypes. Others specify the nature. A detailed report showing additions, disposals, acquisitions through business combination and other adjustments, an amount related to depreciation, impairment losses, revaluation should be provided for each class of assets. Non-current investments. Investment can be classified as under investment in property, investment in equity instruments, investment in preference shares, investment in governments or trust securities, investment in debentures or bonds, investment in mutual funds, investment in partnership firm, other non-current investment. Other non-current investment specify the nature of the investment. Long-term loans and advances. It can be classified under the following subgroups: capital advances, security deposits, loans and advances to related parties, other loans and advances. The above shall also be subclassified as secured, consider goods, unsecured, consider goods, doubtful. Current investments. It can be classified as follows: investment in equity instruments, investment in preference shares, investment in government or trust securities, investment in bonds or debentures, investment in mutual funds, investment in partnership firm, and other investments. Next is inventories. Inventories can be classified as raw material, inventory of raw material, inventory of work in progress, WIP, inventory of stores and spares, inventory of finished goods, inventory of loose tools, stock in trade, goods in transit, any other inventory. Specify the nature of the inventory. Cash and cash equivalent. Following can be classified as follows. First, balance with bank, check draft in hand, cash in hand. Others specify the nature of cash and cash equivalent. Part 2. Form of statement of profit and loss. Name of the company: Reliance Industries Limited. Profit and loss for the year ended 31st March 2021. Particulars: figures for the current reporting period and figure for the previous reporting period. 2020-21 over here will come and 2019-20 will come over here. Revenue from operations, other incomes, these needs to be added. We'll find out total revenue. From the total revenue, expenses need to be deducted. cost of material consumed, purchases of stock in trade, changes in inventories of finished goods, work in progress and stock in trade, employee benefit expenses, finance cost, depreciation and amortize expense, other expenses. Total expenses, we'll find total expenses. Total revenue minus total expenses will lead to profit before exceptional and extraordinary item tax. Profit before exceptional and extraordinary type items and tax. Then exceptional items, profit before extraordinary items and tax. Extraordinary items then will reach to profit before tax, PBT. Tax needs to be deducted from it. So tax expenses, current tax and deferred tax will reach to profit or loss for the period from continuing operations, profit or loss from discontinuing operations, and tax expenses of discontinuing operations. Profit or loss from discontinuing operations after tax, profit for the period, EPS, earning per share, basic EPS and diluted EPS. Let us move ahead, do the notings. Preference share versus equity share. Basis, preference share, equity share. Definition: shares that carry a preferential right as to payment of A, dividend, and B, repayment of capital. Shares that are not preference shares are called equity shares. return, fixed rate or fixed amount. In case of equity share, based on profits available for distribution, profits available for distribution, dividend, priority over equity dividend, that is paid first, after payment of preference dividend, repayment of capital, paid before repayment of equity capital, paid after entire preference capital is repaid. Arrears of dividends, generally accumulates unless specifically said to be non-cumulative, no accumulation of unpaid dividend, no profits means no dividend. Redemption, redeemable as per terms of issue and provisions of Act, not redeemable till winding up, even in winding up will be repaid after preference shares will be repaid after preference shares. Voting rights generally restricted, carries right to vote on all matters if if dividend remains unpaid for all the prescribed period. Voting rights is unrestricted, that is, holder can vote at any matter at any meeting or the shares may be issued with may be issued with varying voting rights varying voting rights. Further issue of shares. Principles relating to rights or bonus share is not applicable. Fresh issue to be offered first to existing holders, that is, right issue and and fully paid bonus shares offered to all members. Control or management. No right to take part in management. In case of preference share, in case of equity share, equity shareholders are the real owners hence have a right to control the management of company. The management of company. I believe you understood. We are stopping here. We are stopping here. Thank you.